All right, let's talk about a company that has one of the most just absolutely eye-watering numbers you'll ever see in the stock market. We're looking at Orchid Island Capital, or ORC for short. Now, it promises something that seems almost too good to be true, and as we're about to find out, that promise comes with some serious strings attached. Just let that sink in for a second. 19.7%. Seriously, in a world where you're lucky to get, 4 or 5% from a high-yield savings account, a number like this feels like it's from a different galaxy. It's a kind of thing that makes you just stop and wonder. I mean, really, what if you could get nearly a fifth of your investment paid back to you in cash every single year? Well, that is the incredible magnetic pull of ORC. And to pull this off, they operate in a very, very specific part of the financial world. You see, ORC is what's called a mortgage REIT, or an mREIT. Now, in simple terms, they're not buying up apartment buildings or office parks. Instead, they invest in the loans themselves, mortgages and bundles of mortgages. They basically make their money on the difference, or the spread, between the high interest they earn from those mortgages and the low interest they pay to borrow money. Okay, so to kick things off, let's pull up the company's recent report card. Let's see how it's actually been doing lately. So if you look at the first half of October, honestly, things look pretty stable. The stock price is up a little over 1.5%, and it's just kind of cruising along right in the middle of its 52-week range. So on the surface, no big red flags are waving. But, these little day-to-day price moves, that is not the real story here. The real story is why people are so fascinated by this stock to begin with. And that brings us to the bull case. This is the exciting part. The powerful reasons investors keep coming back to ORC, even with all the risks that hang over this kind of business. And number one, with a bullet, is that dividend. I mean, look at this. ORC pays out monthly, which is a massive attraction for anyone looking for regular income. They just declared another 12-cent per share dividend for October, which keeps that colossal 19.7% yield very much alive. Plus, the company's management has come out and said, yep, we are committed to these payouts. And on top of that, their early numbers for the third quarter are looking pretty good. Now, the metric you really got to watch with an mREIT is its book value per share. It's basically what the company would be worth if they sold everything off. And that number is actually expected to have increased. That is a huge positive sign that the company's core foundation is getting stronger, not weaker. And it's not just the company tooting its own horn. Some analysts are echoing this optimism. With the stock price hanging around the low sevens and a consensus fair value target of around $8, you can see the argument, right? The thinking is that the stock might actually be on sale, giving you a shot at some growth on top of that monster dividend. But you knew there was a but, right? With any investment that dangles a return this high in front of you, you've got to ask yourself, what's the catch? And that brings us to the other side of the story, the bear case. This is where we have to lift up the rug and look at the risks hiding underneath. And believe me, this other side is so important. A nearly 20% yield is never a free lunch. It is payment for taking on some serious risk. And one of the biggest risks is staring us right in the face when we look at the company's valuation. Just check out this price-to-sales ratio. ROC is trading at a multiple of almost 44 times its sales. Now, compare that to the industry average, which is way down there, around 5. This tells us the stock is incredibly, some would say wildly, expensive for the amount of revenue it's bringing in. That's a massive red flag, but it's not even the main risk. No, the single biggest worry for anyone who already owns the stock is something called equity dilution. And while it's a common tool for companies like this, ORC seems to be using it a lot. So what exactly is dilution? Well, it's a double-edged sword. On one hand, it's how the company raises money. They create and sell new shares and use that cash to buy more assets and grow the business. Sounds good, right? But here's the catch for you, the investor. Every single new share they create makes your piece of the pie just a little bit smaller. So the very thing they do to grow the company is also watering down your ownership. And we are not talking about a small amount here. The number of shares just exploded from around 127 million in June to almost 152 million by October. That's a jump of nearly 20% in a single quarter. It means every investor's stake in the company just got stretched that much thinner. So you've got this massive dividend on one side and these really significant risks on the other. It's a real tug of war. So what is an investor supposed to do?
Well, let's break down the survival guide for navigating a stock like ORC.
All right, the most important thing is to be smart about this. First, you have to hedge that yield. Never forget that a dividend this high is not a guarantee. It can be cut. Second, keep your eyes glued to that book value. Circle October 23rd on your calendar, because if that earnings report shows a drop in book value, that could be a serious warning sign. Third, and this is huge, understand the bigger picture. These companies live and die by what the Federal Reserve does with interest rates. And finally, manage your position size. If you decide to jump in, a stock this risky should only ever be a small, speculative slice of a much bigger, more diversified portfolio.
And that really brings us right back to the central dilemma, doesn't it? ORC is offering this truly extraordinary stream of income, but it's all balanced on a knife's edge of crazy valuations, constant dilution, and interest rate roulette. In the end, it all comes down to a very personal question you have to ask yourself. For a chance at a 20% return, how much risk are you really willing to stomach?